Hi there, thanks for joining us for this week's mortgage market update. My name is Erin.
And I'm Todd.
Let's get started because we have a lot to cover this week. You may have heard last week that IndyMac, one of the U.S.'s biggest lenders and banks, went under and was seized by federal regulators. This is the third largest bank failure in U.S. history at $32 billion in assets.
We would like to take this opportunity to remind our clients about the FDIC and its insurance limits so you can protect yourself to sleep better at night. The FDIC, or the Federal Deposit Insurance Corporation, was started in 1933 during the Great Depression to protect depositors and also to limit any runs on the bank. This means the main thing here to remember is not to run to the bank and withdraw all your funds like what happened this week to approximately $1.3 billion worth of IndyMac deposits, but rather to make sure you're adequately insured. In the U.S., only $4.2 trillion of the bank's $6.9 trillion of deposits, or roughly 62%, are covered by the FDIC insurance limits.
Wow.
In IndyMac's case, this equated to about $1 billion not being insured that affected about 10,000 depositors. The remaining shortfall was insured by the FDIC and is expected to cost them $4 to $8 billion, or roughly 10% of their reserve account.
The FDIC basically covers up to $100,000 per depositor per banking institution. They would add up all the accounts in the same depositor's name per banking institution to get to that amount. Differential ownerships can affect these amounts. For example, a joint account shared by two parties with equal access to the funds would have up to $100,000 insurance per party or $200,000 coverage, and so on. It's extremely important that you make sure an issue such as equal access to the funds or old notations on bank records doesn't cause you to be underinsured. Retirement funds are treated separate from this and are insured up to an additional sum of $250,000.
So, what should you do now to protect yourself? First of all, confirm specifically that your bank accounts are insured deposit accounts. Some banks offer investments that are not insured, and you need to make sure that your funds are in one of them. Secondly, confirm your insurance limits. If the totals in your bank are over the insured limits, consider transferring the surplus to another insured deposit institution or other investments that meet your risk tolerance. The bottom line is, you've worked hard for your money. Make sure you take the time to evaluate your insurance status and the safety of your deposits. If you have any more questions on this, you can reference the FDIC website at www.fdic.gov, and we'll have a link below.
For those of you who have mortgages right now with IndyMac, don't be alarmed. As long as your loan has funded, it's business as usual. Even if IndyMac is bought out by another bank, at the most, you're just going to have to send your mortgage payment into another bank. However, if you happen to have a loan locked right now with IndyMac and you're in the process of a refi or a purchase, we'd highly recommend that you have a backup lender because many of these loans are questionable to fund in a timely fashion, if at all.
And now on to our next big story of the week. It came out last week that conforming mortgage regulatory agent giants Fannie Mae and Freddie Mac were in dire financial straits. However, the U.S. Treasury just announced that their rescue plan to bail out these two agencies, which combined insure over $5 trillion in mortgages and are currently accounting for the majority of all mortgages that are being originated in the industry today.
The three main points of the rescue plan are the U.S. Treasury will extend additional lines of credit to Fannie Mae and Freddie Mac. Pending congressional approval, the U.S. Treasury will also purchase equity, either preferred or common stock, in Freddie and Fannie. The Federal Reserve will also open a discount window allowing Freddie and Fannie access to short-term borrowing from the Federal Reserve.
And you may ask, how does this affect you? Well, the federal government may bail out these two giant mortgage entities and avoid further economic downturn. However, it could be at a cost. Taxpayers may eventually pick up this burden, and you certainly can expect regulators to crack down on more revisions.
In light of current events, the Federal Reserve has decided to likely postpone any rate hikes until 2009. It appears they are more concerned about the weak economy than combating inflation.
Wow, that's a lot, and we certainly didn't want to come across as the sky is falling, but rather to keep you updated so you can make informed decisions. Don't let all of this get you down. We look at it as an opportunity for those that are ready. Remember, the highest returns come to those who think countercyclically and act opposite to the rest of the crowd. Interest rates are still great, with rates on A paper for owner-occupied purchases in the low 6s and the high 6s to low 7s for investment property.
Please give us a call today if you have any mortgage questions or you need to get pre-qualified to take advantage of the great deals that we are seeing our clients buy every day.
And lastly, we would like to personally invite you to join us for an upcoming big real estate investment expo this coming Saturday. That's being hosted by the Rental Housing Association here in Sacramento.
It's a great deal for about $30 a person. It includes lunch, a full day of education geared towards the current and prospective landlord. We'll also be a featured speaker, so come check us out. There's also a vendor fair with over 25 local vendors that service the local rental community. If you'd like to register for this event, spaces are filling up fast. You can register at the link below, and the website is www.rha.org.
And we want to wish you a great week, and as always, serving you is our first priority.
Thanks for joining us.
Take care now.